So yeah, I'm going to do a macro educational kind of segment this week in relation to the US yield curve uninverting and the spread between the Canadian and US interest rates and its implication on the USD and Canadian exchange rate. So, this is essentially a follow-up segment on the inverted yield curve, as I previously discussed the U.S. yield curve inverting back in late 2022, which remained inverted for almost the last 2 years and reached its lowest level since 1981. But the yield curve has been steepening essentially and recently uninverted this fall. So I thought that I would go into what this all means and explain how the yield curve has historically performed in relation to the business cycle. So of course, first, what is the yield curve? Well, the yield curve shows the relationship between yields and maturities of bonds with comparable credit rating. So for this exercise, I am going to be looking specifically at the US Treasury yield curve, which is a comparison of government issued bond yields of different maturities. And typically, when we are measuring the yield curve, we're looking at the difference between the rate on the 2-year maturity and the 10-year maturity Treasury. So generally, shorter term yields tend to represent what investors believe will happen to central bank policies in the near future. And longer dated maturities represent investors' guess at where inflation, growth, and interest rates are headed over the medium to long term, which essentially they call, the term premium. And because of this, the yield curve typically tends to be upward sloping, like the yield curve that I have up on the screen right now from February of 2017. Because again, long term bond investors are being compensated with a term premium for the greater uncertainty of growth and inflation risk of holding a bond long term. So you can see on the screen, the shorter the maturity of the bond here, the lower the interest rate. And when we get all the way up to the 10 to 30-year bonds, they have yields at around 2.5 to 3.2%. However, in late 2022 and early 2023, we have seen this normal upward sloping yield curve go inverted as bond investors are demanding a premium for short term bonds, and long term investors were anticipating inflation and long term rates to decline as the economy slows due to short term rates being elevated. And this is from August 14th, 2023, the yield curve here. And this is what it looked like, and it was still inverted at that time. Now, in the finance industry, the inverted yield curve is generally seen as an indicator of a coming recession over the next 6 months to a year. But over this period of time, when the yield curve for treasuries inverted and has since uninverted, the US economy continued expanding. So, how has the yield curve generally acted during the business cycle in the past? Well, at the peak of a cycle, the yield curve tends to be flat or inverted because the economy is performing well and inflation begins to become an issue, leading central banks to raise short term rates, and long term bond investors begin to anticipate for growth, inflation, and interest rates to decline. As the economy goes into a contraction, central banks begin to decrease short term rates as inflation subsides from the economy slowing. So the yield curve begins to steepen. And at the trough of the cycle, the yield curve becomes very steep because inflation is quite low and the central banks have interest rates very low to help stimulate the economy out of the downturn. And as we go back into the recovery and upcycle, the yield curve tends to flatten as the economy heats up, inflation increases, and the central bank increases short term interest rates. But again, despite seeing the yield curve invert, which it's supposed to do at an economic peak, we have continued to see the US economy expand. Now, because of this, there's been a lot of debate on whether the yield curve is still a good predictor of the business cycle, as we have seen an inverted yield curve in unison with continued strong economic data. And now the yield curve is beginning to steepen, which again is typically what we see during a contraction, like I just went over. So, are we headed for a recession? That's the $1 million question. Who's to say, of course, as an inverted yield curve has given false signals in the past. And last time I did this segment, I went over how Goldman Sachs indicated that this time is different because the term premium is well below its long-term average. Or in other words, investors are not being compensated for the risk of holding long-term bonds. But regardless, if we head into a contraction or not, as an investor, understanding how the yield curve has generally acted in relation to the business cycle is a good piece of information to know. Now, I wanted to extend this conversation a bit further to the difference between US and Canadian interest rates, or essentially the spread between the countries' yield curves, and what this implies for the Canadian US dollar exchange rate. Now, the Canadian and American economies are closely intertwined and tend to perform similarly. And typically, we do not see much economic divergence. But this is one of those times as the Canadian economy is slowing much faster than the US, resulting in different monetary policies and inflation expectations. And as you can see up on the screen here, the blue line is the spread between 10-year US and Canadian bond yields, where investors can get much better bond returns in the US compared to Canada at this time. And the red line is the US Canadian exchange rate. So the higher the red line goes, the more the Canadian dollar is devalued. Now, the reason for this relationship is that higher interest rates in the US compared to Canada will increase foreign investment in the US as investors look to hold US bonds over Canadian, which directly impacts the demand for Canadian and US dollars, impacting the exchange rate. Now, there are other things at play here. Of course, the economy is very dynamic, but something else that is potentially impacting the devaluing of the loonie right now is the fear of Trump tariffs. So that's more sentiment, at least in the near term. But yeah, I just wanted to highlight the interest rate spread and the implication for the exchange rates, as we are hearing a lot about the potential strength or the expected strength of the U.S. dollar here.
So any comments from you two on that?
Are you guys still awake?
Just barely.
No, I think it's good to look at some of these macroeconomic things, but you always just have to be very careful about how statistical correlations are used to try and create or imply predictive power, right?
Sure.
Now, Brennan kind of explained did a good job of explaining what's happening with the economy at the different points in the yield curve change. But I mean, I remember back, it was 2019, the yield curve inverted back then. People were worried about it. Of course, then we had COVID right after. So that might have been, an unusual situation. But one of my favorites, just in terms of, predicting what's going to happen with the economy or the market, just with one thing is it's something called the Super Bowl effect, whereas it was back in the 1970s. I believe it was a statistician found that there was a very strong relationship between who won the Super Bowl and whether or not it was going to be a bull market or a bear market for the S&P 500 that year, right? I think it was, if it was the AMC team that won it, was going to be a bull market. It was the NFC team that won it. It was going to be a bear market, something like that, right?
AFC, NFC, yeah.
Yeah. So it was, it had a very strong predictive power at the time when you were looking at just the historical data. But, clearly there's no bearing with who wins the Super Bowl as with respect to how the stock market is going to perform. Like there's no logical connection there really, right? So in statistics, there's many false correlations out there where they're just, things are correlated, but it's just by happenstance, you're going to find a lot of false correlations, and it doesn't necessarily mean they're predictive. Now, obviously, with the yield curve, that's more closely connected to the economy, so you could actually have a logical connection there. But you just always have to be wary because the economic engine is just such a massively complex machine that trying to make these simple predictions, they typically tend to fall short.
Yeah. You have whatever, I think it's like 15 or something examples in modern history. You don't have a super large count of yield curve inversions or recessions in general. So you don't have a big sample size like what you would want to do. Exactly. So even there, it weakens the statistical relevance of it, even if you do see the connection between recession and yield curves.
Yeah, I mean, how many times has the yield curve inverted in 50 years, 100 years, right?
Yeah, and just the effect on FX, and then bring it back to like when we look at basic investors' concerns about investing in the US because they think of a lower Canadian dollar, and that will hurt their investment. We hear that all the time. And, you know, there's been a worry for 5, 10 years. Well, should I not be investing in the US because our currency, the Canadian dollar, the US dollar be stronger, the Canadian dollar will be weaker, or will it flip, reverse? But you guys have any idea of where, you know, over the past 5 years, you know, how much the Canadian dollar is down versus the US dollar, just off the top of your head?
I want to say 10%, maybe.
Yeah, I mean, it's good. It's 5.4. So,
Yeah.
you know, and you know, you look over, like we've heard over that entire period. I mean, it's not nothing. I'd like to see a stronger Canadian dollar. It'd be nice. I mean, it's actually weaker is good for some of the companies we hold in our portfolio, but you know, a 5.4%, like you would think with all the negativity, it would be 10 something, right? But 5.4. If you would have not bought a U.S. stock because you thought, you know, the Canadian dollar was, I mean, you should have probably bought it then. But if you know, there's reasons we hear, oh, I don't want to buy it, you know, because you know, because you think it's the wrong time. You know, for example, Microsoft is probably up 400% over that time. And if your decision was because you thought there was going to be a stronger or weaker Canadian dollar, that really washed out to probably a 5% difference, and you missed out on 390 something percent, right? So, I mean, again, that's what we kind of tell investors. The currency should often be down the rung in terms of what you're looking at. It should be the company you focus on in terms of the returns in your portfolio,
And
kind of bringing it around to that.
yeah, exactly. Like, and even like with me looking at like, you know, again, this is more like the short term implications of, you know, potentially like foreign direct investment or like, you know, chasing yields. When we look like longer term, it's typically trade flows which will impact currency. So, you know, despite someone saying, oh, you know, this spread here, we should see the USD you know, appreciate. Well, longer term, that might not hold true depending on, you know, fund flows essentially, or, you know, trade flows. um I think I'm recalling that right from the, you know, CFA studying, I believe. Maybe Brett can correct me on that, but I believe that is you know, again, the short term versus the long term, and how, you know, analysts are looking at the macro generally.
Brett fell asleep right when you started your
Yeah,
session, so
no,
he's like,
it's
I don't
"What?
blame
Come
him.
again?"
it's a
So
flashback.
yeah,
Yeah, yeah.